Right, coming back again to the trade on the 11th of October, I want to look at the bets in a bit more detail now. So on this day, we've got the prior close here. Right, so what I call parity is a straight line. I'm sorry about this rather crooked line you're going to get here, but it's a straight line where the Dow is unchanged on the day. So that's the key area to look at. Now the first bet was for the Dow to close up more than 50 points. So with the close on the previous day around 14,075 or thereafter, then we know that the 50 point plus 50 is around here. Whoops. Okay, so we traded here. We sold at 83. I mean, at that point, it seemed a high probability that the Dow would close up 50 points, and so it was possible to sell it at a very high price. Clearly, as it came down through this line, the bet went cheaper and cheaper and cheaper. Now, initially I illustrated the potential of this bet. I didn't trade it perfectly. I did take profit on the way down, and I mean this particular bet was the most profitable bet initially because it fell quite sharply. So having sold at 83, I think I cleared out around 20 down here somewhere. So it was a good profit. I mean, it was a smaller position, but it was a very good profit. And I have no trouble taking that kind of profit. It's having got, say, 60 points of profit in hand, why risk the whole 60 points of profit just to make another 20 points? It's a debatable point. It's a point we'll be looking at in more detail as we go through this course, but it's acceptable. It's certainly not a hugely bad thing to do. All right, the next bet was the Dow to be down on the day. So once it goes below this line, it's down on the day. Now this one was slightly more difficult, I found, because my bets went from, as you will remember, I paid 2.9 for the bet. So at this point, once an up-down bet goes to parity, then it goes around the 50 points. So at here it was valued at about 50 and probably about 60 odd down here. Now this is the more difficult bet to hold. Because having got to 60 odd, which is a nice profit, but there's more to play for with this bet. 40 more points there, which I didn't really want to leave on the table. But it's very difficult when you see this kind of sharp rally come in to hold that, because you see your bet go from about 50 here, 60 here, then you can see a sharp bounce up, and soon you might be looking at a bet that's only priced at 30. Now, I should never have bailed out there, but I did take profits at that point on some of that position. You'll see here, if you look, I mean, we're talking about Elliott 5s, we've got a 1, 2, 3. So this thing here counts as a fourth. However, this could be a corrective decline, and with corrective moves they come in 3 parts. So this could have been an important low. But again, markets tend to retest important lows, so there was no real reason to bail out at that point. But this, in fact, is the exit strategy that defines your success as a trader. Entry is actually the easy part. It's not entering trades that's going to make you successful. It's how you exit trades. The winning traders exit in the best way possible. The losing traders tend to be frightened and get out at a loss. The winning traders get out at a profit. Both can enter at the same level, but it's the exit that's so important. I just want to add or repeat that the key point of this course is so that you can take this sort of trade, that you can identify opportunities, you can capitalize on those opportunities, and my aim is that once you've been through this course, that's what you'll be able to do. Now then, okay, the bet then obviously crashed down, and this fifth wave decline came in, and I mean, this bet was a bit of a. Best thing to have done would have been just to fall asleep, put the bet on, fall asleep, wake up £8,000 richer a few hours later on. It's difficult. It's more difficult sometimes to just not do anything. I just let it run. I find that quite difficult. I think every trader finds that quite difficult. You've got a really nice profit in hand. It's very, very tempting to take it. Now the third bet was to be the low to be -20. Basically, the previous low had been sort of at the open, so that was, at this point in time, that was the bet that looked like it's going to expire at 100, because the low is going to be in that range. So once the market came down below that low, as soon as it came down below that low, the bet went to 100. It was no problem at all, but in fact that was the nicest bet of them all, because I do like bets that just go all the way when something happens. The problem with the up-down bets is that they just run all the way to close, and it's the final level on the market that counts. With a bet like the low to be, that's not the case, and you just need one tick below or above the relevant level, and the bet goes all the way at that point, which is a much nicer way of trading. Unfortunately, because of this factor, the bets are more expensive, or you have to incur more risk when you trade them. So again, it's a balance between risk reward, which is what trading is all about. And although I'd much rather trade the bets that expire like that all day long, sometimes the prices just aren't appealing to me.